Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, good afternoon. Thank you for coming on today.
Happy to be here.
Well, let's start with some headlines from Wall Street, where the Chinese ride-hailing service Didi has had to cave to pressure from the authorities in Beijing and will withdraw from the New York Stock Exchange and list in Hong Kong instead. It's a sign, some would say, for investors that capital markets of China and the U.S. continue to decouple. What do you make of the situation?
Okay, well, if it is decoupling, then it seems like both sides, the United States government and the Chinese government want it. The big problem on the Chinese government side seems to be technological and financial regulation. It's been less than 6 months since Didi made its IPO in the United States. It hasn't been doing too well. It lost about 44% of its stock value, and shares especially fell very sharply after Chinese regulators asked Didi to formulate a plan to delist from the United States stock market. The Chinese government had concerns about leakage of sensitive data, personal data, even before the Didi went ahead with the IPO in the United States. But Didi went ahead with the IPO without resolving the cybersecurity issues raised by the Chinese government. So the Chinese regulators seems to be getting tougher on these internet firms. Didi is not the first to be hit by harder pressure by the Chinese regulators. Chinese regulators also introduced new rules on antitrust for internet platforms and strengthened data protection laws. So this might be the first time that they're using these regulations to make a company delist from the U.S. stock market. Now, on the U.S. side, the United States government was not particularly happy with Chinese firms in the U.S. stock market either. The SEC, the Securities and Exchange Commission, has just finished designing rules which implement U.S. holding foreign companies Accountable Act of 2020, which allows the SEC to delist foreign stocks for failing to meet audit requirements. This act was passed in the United States Congress after Chinese regulators denied requests from the U.S. Public Company Accounting Oversight Board to oversee audits of public companies. So they seem to be fighting over who has the right to see the data, at least for the Didi company in question. Now, Chinese firms used to come to the United States because it was the place to go when they wanted to raise large capital, but Chinese markets have become large enough, if not mainland China, then Hong Kong has become large enough so that they do not necessarily need to come to the United States. Skills seem to be now available more and more in the Chinese market. Goldman Sachs and J.P. Morgan are strengthening their mainland China businesses, and some press reports are saying that Chinese government is now closing loopholes that allow companies to keep their corporate control in the mainland but list overseas. So we may no longer see these huge IPOs of Chinese companies in the U.S. stock markets.
Well, in the U.S. markets, in New York on Friday, they were down again. The jobs report for November coming in lower than hoped, plus fears that the pandemic could cause economic activity to contract again. Another hit to travel-related shares there. What's the story in the global markets as we start a new week?
Okay, well, U.S. had been hit by scores of some bad news for the stock market in the last week. On Friday, there was a disappointing jobs report. Only about 210,000 jobs were created when most analysts were expecting higher than 500,000. But unemployment rate is also down from 4.6% in October to 4.2% in November. So Omicron variant may be scaring off a lot of people from coming in to the job market. Also, the so-called Great Resignation is continuing. 4.4 million Americans left their jobs in September, and job openings remain near record high. And the job gains are the slowest in the face-to-face services sector, and obviously Omicron variant is not going to make people want to come back to those jobs. Now, unlike the past when you heard economic bad news and stock markets go up because the investors perhaps thought that the Fed, because of the bad news, would lower the interest rate or extend the period of low interest rate. Now, bad news seems to be reflected more and more in the stock prices. That's probably because they are now convinced that Fed is going to raise the interest rate sooner more than later. Fed Chairman Powell testified to Congress that inflation is no longer transitory. Tapering and interest rate increase may be accelerated. So that may be the reason why nowadays bad news is actually reflected as bad news in the stock market. For the week, Dow fell by 0.9%. For the week, S&P fell by 1.2%. And for the week, NASDAQ fell by 2.6%. And one other perhaps asset of note, Bitcoin is down nearly $10,000 since late November, $20,000 since early November. A lot of people thought that Bitcoin would go up because it would act as an inflation hedge, but so far it doesn't seem to be acting that way. European market, since December 1st, it's been down following the U.S. market. And again, the Omicron variant is probably responsible. Asian markets, as usual, Nikkei, Shanghai, and Hang Seng is all acting differently from each other. Nikkei, after falling in late November, is holding steady, and Shanghai, it was rising generally last week, though it came down today, and Hang Seng, it rose on the latter part of last week, but it was falling today.
A great point on Bitcoin. And today in Korea, stocks were mixed. The benchmark Kospi starting the session lower, but ending with a gain. The Kosdaq ending lower, though, with some pretty big declines for the top 10 companies on that index. Tell us about the domestic market.
Okay, well, Kospi, it closed at 2,973.25. It went up only 0.17%. I say only because last week we had gains and losses, but they were all very large. So we didn't have any really slow-moving days last week. But today, even though it went up slightly, 0.17%, it's, I think, more better interpreted as holding still. It started out at a steep loss in the morning, but it gained steadily throughout the day. Individuals sold, institutions and foreigners bought. But again, the volume of sales today were fairly small. Kosdaq, it closed 991.87. It was down 0.66%. Everybody sold, though individuals, they were on the net very close to zero. Again, they had some large movements last week, but it seems to be, if you compare it to last week's standards, more or less holding steady today.
Right. Well, briefly, Professor, before we go, what's on your radar in the week ahead?
Okay, well, Bank of Korea has balance of payments for October and population growth estimates for the 2020 to 2070. And then on the U.S. side, the Energy Information Agency will publish their short-term energy outlook report, and the job opening and labor turnover report is also due. We'll have to see that for what wage pressure and possible inflationary factors there are. And the big one for the United States is consumer price index on Friday.
All right, Professor, nice and brief there. Appreciate that. And thank you, as always, for coming on and sharing your insights with us.
Thank you.